We ran an event study on 1,821 mergers and acquisitions, filings from 2000 to 2025. An earlier version showed a positive acquirer reaction in the first days after a filing. We cleaned the data and it vanished. What survives is slower. Both targets and acquirers drift below the market over the following 1 to 3 months. Here's what the data actually shows and where it falls short. This is an event study, not a portfolio backtest. We don't construct a portfolio, hold it, and measure returns. Instead, we measure what happens after each individual mergers and acquisitions announcement, then aggregate across thousands of events to test whether a systematic pattern exists. Every mergers and acquisitions announcement creates 2 separate events, one for the target and one for the acquirer. The patterns are different on each side, so pulling them would obscure both. We tag every event as either target or acquirer and run the analysis separately. The framework has 5 steps. First, extract the target symbol, acquirer symbol, and transaction date for every filing. Second, record the adjusted close price for each stock and for SPY, the S&P 500 index fund, on the entry date. Third, measure returns at 1, 5, 21, and 63 trading days after the filing. Fourth, compute abnormal returns by subtracting SPY's return over the same window. These are called cumulative abnormal returns. Fifth, aggregate by category and test for statistical significance using t-statistics. We also added 2 data quality controls this time, and they changed the result. We stripped phantom price rows, where a stock's adjusted close doubles and reverts within a day or two, which are vendor data errors rather than real moves. And we drop events priced under $1 or with a first-day move above 200%, which flags penny stocks and bad price data. Those controls trimmed the sample by about 12% and erased the short-term signal an earlier run had reported. Standard finance theory predicts targets jump on announcement and acquirers drop. Brohl's hubris hypothesis explains the acquirer drop. Chief executives overestimate their ability to create synergies, pay a premium that exceeds the value they can extract, and the market prices that in immediately. The critical context before reading any result: our measurement window starts at the Securities and Exchange Commission filing date, not the press announcement date. Press releases come first. SEC filings follow, sometimes days later. Whatever immediate price reaction happens on either side has already occurred before we start measuring. What we capture is post-filing drift, not the announcement reaction itself. There's a second lesson in this one, about data quality. An earlier version of this study, before the cleaning step, showed acquirers gaining a significant 0.28% at 1 day with same-day entry. After we removed penny stocks and phantom price spikes, that number collapsed in near zero. The signal was a handful of low-priced stocks with bad data, not a market reaction. Start with the short-term windows, because that's where the story changed. Neither side shows a significant move in the first week. No significant first-week signal on either side. The earlier same-day acquirer gain of 0.28% doesn't appear once the data is cleaned. Same-day and next-day entry both land near zero. Execution timing isn't the story. Data quality is. The pattern that survives is the medium-term drift. Both sides underperform the S&P 500 over 1 to 3 months. For targets, the cleanest number is 21 days, negative 1.41%, significant, with 363 of 371 events still trading, so survivorship isn't the cause. For acquirers, the drift reaches significance at 63 days, negative 1.18%. That's a mild acquirer curse, real but small. Here's the full side-by-side. Targets cross into significance at 21 days, acquirers at 63. Neither side moves the market in the first week. The target 21-day drift is the cleanest finding in this dataset. It's negative 1.41%, significant with a t-statistic of negative 3.37, covers 363 of 371 events, and doesn't rely on survivorship since nearly all targets are still trading at that point. It spans 25 years, including the dot-com bust, the financial crisis, and the 2021 surge driven by special-purpose acquisition companies. The acquirer side is weaker but consistent. No significant move until 63 days, where it reaches negative 1.18%. That's the integration risk discount the literature predicts, just slower and smaller than the textbook version, and the short-term acquirer gain that earlier analysis cited disappears under data cleaning. Which is the more important correction here? Deal activity is far from uniform across the sample period. The 161 events from 2006 to 2010 reflect the financial crisis, when lending freezes dried up deal financing. The rebound into 2016 to 2020 reflects the long bull market that followed, where low interest rates made deal financing cheap and corporate balance sheets were flush with cash. The 2021 to 2025 period is the most active, with about 37% of all events landing in that 5-year window. The 2009 credit crisis produced just 17 events. 2021 alone generated 245 events, driven partly by the SPAC boom. More than a quarter of all 1,821 events come from 2020 to 2022, which means recent years carry disproportionate weight. The medium-term drift holds across subperiods, but the large recent cluster is worth keeping in mind. The target result at 63 trading days needs direct explanation. We had 371 target events at the one-day window. Only 286 remained at 63 days. Those 85 missing events are mostly completed deals where the target was delisted after acquisition. When a deal closes, the target stops trading and we have no price data at that horizon. The targets still trading at 63 days are disproportionately those where the deal stalled, faced regulatory challenge, or was abandoned outright. Failed and troubled deals are disasters for target stocks, which crash back toward pre-announcement levels. The negative 2.79% measures that population of troubled deals, not M&A targets in general. Crucially, the 21-day result of negative 1.41% is not subject to this problem. With 363 of 371 targets still in the sample, survivorship can't explain it. For acquirers, survivorship isn't an issue. The acquiring company continues trading regardless of whether the deal closes. No deal price or terms means we can't compute deal spreads, separate cash deals from stock deals, stratify results by premium size, or identify which deals succeeded and which failed. This is a post-announcement return study. It's related to merger arbitrage, but it isn't the same thing. The merger arbitrage return depends on the spread between market price and deal price converging at close. We can't measure that. The filing date measurement window is the most important caveat for every number in this analysis. We're not capturing announcement reactions. We're capturing what happens after the announcement is already public and documented in an SEC filing. If the press release comes Monday and the filing comes Thursday, 3 days of price movement are invisible to us. Because failed deals aren't separately identified, the short-term windows pool successful and failed deals together. Failed deals are rare but catastrophic for targets, so pooling adds noise we can't fully quantify. Dataset coverage is uneven across the 25-year period, with far more filings after 2016. The earlier years have thinner samples, which adds noise to sub-period analysis. The SPY benchmark doesn't control for sector or size, so an acquirer in a sector with a strong tailwind will look better than it should. The M&A deal screen and the full event study results are on cetaresearch.com, link in the description. Full results and methodology are on the blog. You can filter by date, market cap, and exchange to see current deal flow on both sides. The backtest code is open source at github.com/cetaresearch/backtests. If you want to see how other event-driven strategies stack up, or covering spin-offs, earnings surprise momentum, and index reconstitution in upcoming videos, subscribe and you won't miss any of them.